Risk-based KYC refers to a compliance approach where financial institutions apply different levels of customer verification depending on the risk a customer presents for money laundering or terrorist financing. Instead of applying identical verification procedures to every customer, institutions assess risk indicators such as occupation, country of residence, nature of business activities, expected transaction volumes, and ownership structure. These indicators help the institution categorize customers into low, medium, or high-risk groups. A uniform due diligence process may seem straightforward, but in practice it often creates inefficiencies. When a low-risk salaried individual opening a savings account is subjected to the same level of investigation as a complex multinational company, the onboarding process becomes slow and costly. At the same time, high-risk clients may not receive the depth of scrutiny necessary to detect suspicious activities. A risk-based framework ensures that compliance resources are allocated intelligently, allowing financial institutions to concentrate enhanced monitoring, verification, and documentation requirements on customers who present greater financial crime risks. Global regulatory expectations for risk-based KYC originate largely from the standards issued by the Financial Action Task Force, commonly known as FATF. The FATF framework requires financial institutions to identify, assess, and understand their exposure to money laundering and terrorist financing risks. Once these risks are identified, institutions must implement customer due diligence measures that are proportionate to the level of risk identified. For example, simplified due diligence may be sufficient for low-risk customers, such as individuals receiving regular salaries through transparent banking channels. In contrast, enhanced due diligence must be applied to higher risk categories, including politically exposed persons, clients from jurisdictions with weak AML regulations, or companies with complex ownership structures. The importance of this framework became evident during the investigation of the Danske Bank Estonia branch in 2018. Authorities discovered that large volumes of suspicious cross-border transactions had passed through accounts of non-resident corporate clients with limited verification and weak monitoring controls.